Hi everyone, this is Kris Fleming with KFP Investors and a very important presentation of Lender Chat. If you are brand new to looking for ways to finance your investment real estate endeavors, this is the video that I have been meaning to create for you for quite some time. Before I get started, of course, I have to give you our disclaimer that we are not attorneys, CPAs, or certified financial planners. We do not give legal, tax, economic, or investment advice. We disclaim all liability, and you should always consult with your own professional and qualified advisors in those regards. Just a little bit about me. I'm a serial entrepreneur. I started my first business to my best recollection when I was about 12 years old. I had a career in banking. My last role in banking was as a commercial loan officer and an underwriter specializing in investment real estate. In 2021, I launched KFP Investors because I, as a real estate investor, wanted a better way to make money, invest, scale up, move forward. And I decided that if I wanted it, then probably some others would too. So now we have a team, everybody works remotely, and we serve multiple states. Today's topic is about financing your investment real estate. So buckle in. I'm going to try to make this quick and comprehensive. Of course, cash is not financing, but if you got the cash, that's one way to fund investment real estate. Seller financing is very strong. Conventional government-backed lending, like the mortgage you probably acquired when you purchased your home. A joint venture, which is when two real estate investors partner together to acquire property. Hard money, which is typically short-term, interest-only, high rate money. It's higher risk for the lender, so it's higher interest rate to the borrower. Bank financing, which is where a lot of folks turn once they have finished using conventional lending. And then non-QM DSCR loans. That is a lot of letters. What in the world does that mean? Well, we will get to that. Conventional loans are what most investors are familiar with. You're talking about maybe Freddie Mac or Fannie Mae backed lending. It is the type of loan that you probably got when you acquired your primary residence, or maybe you got a VA loan or a USDA loan. All of those are all supported and backed by government commitments. They can be used to fund investment real estate, but in my opinion, they don't fund investment real estate very well. Here's why. They do typically have a 30-year fixed rate. They typically have low fees to acquire the loan. They do not have prepayment penalties, which is very common in other types of loans. They have the lowest interest rates. It's tough to beat a conventional financing interest rate. You must qualify using your personal income and your personal debt to income ratio. You must borrow and hold title to the real estate in your personal name. They have an extensive underwriting process. Is significantly more documentation and a lengthier process than it is for most other loans. And there is also currently a limit of total 10 conventional loans. So if I am a real estate investor and I used a conventional loan to purchase my primary residence, assuming that I can DTI and income qualify to acquire investment real estate with conventional loans, I can get up to 9 more loans, total of 10. Here's why KFP Investors doesn't do them. First of all, there are plenty of mortgage originators who do these. We didn't feel that it was something that we needed to jump into. We specialize in investment real estate. We don't believe that conventional loans are investor friendly, not least of all because you have to borrow and hold title in your personal name. Additionally, most investors, by the time they have done a few properties, have an expense ratio that just doesn't fit with the DTI. And so it doesn't work out very well. W-2 income is the best way to qualify for conventional loans. What is a DSCR loan? DSCR means debt service coverage ratio. Non-QM means non-qualified mortgage. All non-qualified mortgage means is that it is not your standard 30-year fully fixed government-backed mortgage. So even if you have a conventional loan that's only 15 years, that's a non-QM loan. Well, I have heard a lot of people say non-QM is the new subprime from the early 2000s. That is not the case at all. DSCR loans are most often used for 1 to 8 unit residential properties. Manufactured homes can be challenging. If you have some manufactured homes that you'd like to discuss, please contact us. Take fully commercial properties or multifamily properties that are greater than 8 units to a commercial lender or loan broker, such as Wild Fig Financial. Today, we're going to focus on 1 to 4 unit residential. Property condition. It must be habitable for long-term DSCR financing. That's because the lender is going to underwrite the loan based on the income from the property. If the property is not habitable, then there's no income and therefore it doesn't qualify for the loan. DSCR loans are not a good choice for major rehab projects. Get a fix and flip loan or a rehab loan for those projects first. Pro tip. Make sure that there is at least one working smoke detector on each floor of each unit before the appraisal inspection. That is the number one reason that we have to send appraisers back out to reinspect properties is smoke detectors or lack thereof. These work best for long-term hold rentals, medium-term rentals, short-term rentals. Some DSCR lenders are comfortable with the short-term rental business model. Not a whole lot are just yet. Your best practice is to make sure at acquisition that the property cash flows based on long-term rents, and then if you decide to use it for a short-term rental, you're golden. Group housing, rent by the room scenarios can be very difficult to qualify for DSCR loans at this time. We're hoping that that business model will become more widely accepted very soon. Loan to values are usually 80% at purchase or 75% at refinance for single family residences. They're usually 75% at purchase and 70% at refi for 2 to 4 unit residential. DSCR loans are most frequently used for cash out refinance after a major rehab or to tap into some equity. How is it underwritten? Your credit score is a tremendous factor because remember that the underwriting is based around the income and the value of the subject property. There's not a whole lot of underwriting to it. Credit scores can go down to about 640 at this time. Just know that if your credit score is lower, then your interest rates are going to be higher. If your credit score is higher, then your interest rates are probably going to be lower. That's how that works. The subject property should have at least $1.25 in income for every dollar in debt for every month. So if I know that my mortgage payment is $750 a month on my subject property. 1/12 of my annual insurance is $100 a month. 1/12 of my annual property taxes is $100 a month. And I have an HOA that's $50 per month. That means the total debt calculation on this property is $1,000 a month. To best qualify for a DSCR loan, I'm looking for rents in about the $1,250 or better range, which gives me $1.25 in income for every $1 in monthly obligation. This is the industry standard, but is not an unbreakable rule. There are scenarios where it makes sense to go under 1.25. There are even scenarios where it makes sense to go under 1. So let's just talk about it. A reverse way to back into how much mortgage payment can be afforded by the property is to say, oh, I know that I have $2,000 in monthly rents. If I divide that by 1.25 to get my 1.25 DSCR ratio, then I understand that my allowable debts are $1,600 a month. If I subtract out $165 per month for 1/12 of the annual insurance payment, $120 per month for 1/12 of the annual property taxes, $40 per month for the HOA, that means my mortgage payment can be up to $1,275 per month in order to qualify with a 1.25 DSCR. Experience is not generally required for 1 to 4 unit residential properties. It's very common that lenders are looking for experienced borrowers when they're lending on a rehab or a fix and flip, but that's not common for a DSCR loan. Lenders do not like your first real estate loan to be investment property. They like for you to already be a homeowner. Personal name is generally not required, and quite often entity name is required. We have this discussion with folks who are very determined to use their personal names. However, with DSCR loans, it is almost always required to borrow and hold title in your entity name. A few years ago, a 15% down payment on a single family residence at purchase was quite common. Now it's 20 to 25% in the current economic environment. There usually is not an application fee on 1 to 4 unit residential properties. You may be required to pay for a credit report up front, which is usually about $60 per guarantor. You'll also pay for an appraisal before loan closing. Typical costs right now include title insurance, title search, recording fees, and taxes. These can vary greatly from state to state and even from county to county. Whether you get a bank loan, a private money loan, a hard money loan, a DSCR loan, all of these expenses are the same because they're dependent on the loan amount and the geographic location of the subject property. Origination fees for DSCR loans are usually about 1.5 to 2.5 points. There sometimes are minimums for smaller loan amounts. Appraisals are generally costing about $600 to $1,200 depending on the urgency, the property type, and the location. Processing fees are typical on DSCR loans, and those run about $500 to $1,400. Underwriting fees that are paid directly to the lender at closing are common. We see those about $1,500 to $2,000 depending on the lender and the deal. A credit report fee, as I stated on the previous slide, is typically around $60 per guarantor. We're not going to discuss guarantors today. We may get into that in a future lender chat video. What are the typical terms right now? Interest rates we typically see about 2 to 4 points above the 10-year Treasury yield. Now, I wrote this last night on October 23rd, 2024, and I checked the 10-year U.S. Treasury yield. It was 4.218%. I'm pricing loans right now at about the 6.75 to 7% range, depending on the deal and credit. So this tracks. Loans are typically a fixed rate for the entire 30 to 40 year term. That's right, 30 to 40 years. There are 40-year term products. Adjustable rate mortgages are available, but right now they're not pricing any better, so it doesn't make sense to obtain one, in our opinion. Again, you've got the origination fee, which is usually 1.5 to 2.5 points. We're not going to charge it twice. I'm just telling you about it twice. Often, also, you can buy down the interest rate by paying additional points. Basically, that's like paying some interest up front to get a lower interest rate. The three major products are a 30-year fixed rate, fully amortized term, just like what you probably got on your primary residence. There is additionally a 30-year fully fixed term where the first 10 years are interest only and the remaining 20 years have amortized payments. There is a 40-year product where the first 10 years are interest only and the remaining 30 years are fully amortized. I have never seen a balloon on a DSCR loan. These loans are fixed and they pay out to maturity. Prepayment penalties are sometimes quite the shock to newer DSCR borrowers. 5 years at 5% is currently the industry standard. A few years ago, a 5-year step down was the industry standard. Some states disallow 5-year prepayment penalties. As an example, we recently did a DSCR loan in a state that only permitted a 3-year prepayment penalty. The borrower was forced to buy down the prepayment penalty to only 3 years to be compliant with local regulation. I generally recommend against buying down prepayment penalties whenever possible. I've done the calculations and that's the way it makes sense to me. We can do a future video about prepayment penalties. The paperwork. It may look like a lot on this list, but this is typically it. A copy of each guarantor's driver's license or valid government issued photo ID, contact information for your insurance agent so that we can get the declarations page, all of your entity formation documents that have been fully executed and dated, 60 days of business bank statements, which are generally not required for cash out refinance transactions, current statements for any mortgages that are reporting to your personal credit, So your primary residence as an example, and if you have any other mortgages that are reporting to your personal credit, we need the statements for those as well to make sure that everything is current and there are no arrears. Leases for the subject property if they are tenant occupied during the application process. We have a package right now of 4 properties. 3 of them are tenant occupied. And on the 4th one, it's not leased yet, so we'll use the appraisal figures for that one. The pros and cons of DSCR loans. 30 or 40-year fixed rate is typical. Personal income is not required. The rates are very competitive. They consistently outperform bank and credit union rates, who, by the way, usually have 20 to 25-year terms. Borrow and hold title in your LLC or your business entity, and there are no limits on how many DSCR loans you can have, unlike the limit of 10 on conventional loans. DSCR loans do have higher origination fees than conventional loans or bank loans. I often tell people that they're more expensive to get, but they're less expensive to have. They do include prepayment penalties. Rural properties and unique properties may be difficult to qualify for a DSCR loan. Trusts and layered entities are frequently disallowed. This is my conclusion. I am a real estate investor. I personally use DSCR loans. I have been a conventional loan originator. I have been a bank portfolio loan originator. Now I work with DSCR loans. No, I do not get a discount on those origination fees on my own personal real estate investments. I use DSCR loans. So I've put my money where my mouth is. If you have questions, and I hope you do reach out to us, and you have all kinds of things that you want to know more about, here's how you can find us. I look forward to talking to you again very soon.